You're listening to Therapy for Your Money, a podcast about all things money and finance for therapy practice owners. If you want to feel confident and in control of your financial life, then you've come to the right spot. I'm your host, Julie Harris. I'm an accountant and the owner of Green Oak Accounting. My firm specializes in working with private practices across the U.S., and my team and I have worked with hundreds of private practice owners. I'm on a mission to share all the best practices I've learned along the way because I want you to have a profitable private practice. My new book, Profit First for Therapists, is available at most online retailers. You can get it in paperback, audiobook, or ebook as well. Go check it out. Hello, everyone, and welcome back to Therapy for Money. Today, I'm sharing my unpopular opinion that whole life and universal life insurance policies are garbage products. There, I said it. This is probably not going to be a very popular opinion. That's okay with me. I am quite all right with it. I get pitched by insurance agents for this podcast probably like twice, 3 times a week, every single week. They want to come on this podcast and talk about whole life. And I've always said no, but today I want to talk about just why those are such garbage products and why you should not buy universal or whole life insurance. I have a personal bone to pick with these insurance agents, sometimes insurance agents that are pretending to be financial planners, right? They're not saying I'm a financial planner. They're kind of skirting around it, looking like they are financial planners. They tend to push this product. Do you know why? Because they make a lot of commission from it. They make a big, hefty commission on universal life or whole life insurance, and they make almost nothing when they sell you term life insurance. So when I was in my 20s as a newly married person, I wanted to be responsible. My husband and I were getting our financial ducks in order, and we knew that we needed life insurance. So we asked around, we got a referral, and this lovely insurance agent came to our home to discuss options. And by the way, our home back then was a small 2-bedroom apartment. It was nothing fancy. We were absolutely not rolling in it. We were just newly married folks trying to make a living, nothing crazy. And I remember the exact words that this insurance agent said to me. She said, "Julie, I think you should go with universal life because I just love the idea of you accumulating wealth for the future within your life insurance." Oh my gosh. If I only knew then what I know now. You know what she did not suggest, this insurance agent? Pretending to be a financial planner, she did not suggest term life insurance. We didn't even talk about it. That's insanity to me. I think that should be criminal. A financial planner or even an insurance agent, they should be required to provide multiple options to their clients to explain the cost. But this person was not a financial planner, and I just didn't know that, right? So she suggested universal life, said it was the best thing for me. And I thought, well, this is the professional. I don't know anything about life insurance, so that sounds good. They're recommending what is best for me, right? I was completely wrong. So I did buy this universal life insurance policy. For many years, I paid $250 a month for that policy. And as I learned more about insurance products, I realized, oh, wait, that was a mistake. I should not have done that. So I did get term life insurance for about $30 per month for the exact same death benefit. So I think my policy had a $500,000 death benefit around that time. So that savings, $220 per month. You know what I can do with that savings? I can invest the difference. In reality, back then, I really could not afford $250 a month. That is something that we definitely should not have been paying. It should not have been part of the budget. It didn't work in the budget. But I was trying to make it work because I thought it was so important. So in reality, when we started saving all that money, some of it went to like actual important life expenses, and then some of that went into savings. But if I had just had that money, right, think of how much you could have after a few years if you're saving $220 a month. That's a really big deal. So when I canceled this universal life insurance policy that was supposed to be an investment, right? It was sold to me as an investment. Do you know how much I got? What the wealth was that I had accumulated in that plan? It was $0. There's so many fees and commissions that after 2 years of paying into this plan, that's about $6,000 in premiums over 2 years. I had accumulated $0. I had absolutely nothing left. So I canceled the plan, even though there's nothing left because it was a sunk cost, right? The money's already gone. I didn't want to keep throwing money at something that doesn't make sense. And term life insurance was all that I actually needed at that point. I just needed insurance as a security measure, not as an investment. I am a big proponent of keeping your life insurance and your investments completely separate. They don't need to be combined. They absolutely do not need to be combined. If you're ready to invest, invest. If you need life insurance, buy life insurance. They do not need to be together. I will die on this hill. They should not be together. Here's how you get sold this plan, though. Okay, here's what happens. You're going to get to accumulate wealth in this insurance product. It's a great product. You can then borrow money against it. Okay, so let's pretend that everything goes perfectly and that I have a $500,000 death benefit and that I've accumulated $500,000 in value, which actually would not happen, but let's just pretend. Okay? And let's say, ooh, I now have the privilege of borrowing my own money, right? So I can borrow up to $500,000 against this policy. Okay, that sounds okay. If I die, I have a $500,000 death benefit, but I borrowed $500,000 against it. So guess what happens? The death benefit pays back the loan. My spouse, children, whatever, get $0. Isn't that insane? You accumulated all this wealth and then your death benefit just pays it back? That's madness. It makes absolutely no sense. Now, in reality, usually you cannot borrow all the way up to your death benefit, right? So it might be $250,000 that you can borrow, but still, if you die, it goes back to pay back the loan. So why aren't you just investing your money separately? If you accumulate $250,000 in an investment account, you don't have to borrow it. First of all, you can just take it out and then you never have to pay it back. So why not do that instead of borrowing money that you put in there? You put it in there. It's not actually a loan. You put it in there and then not actually getting the death benefit that you paid for. Let's not do that. Let's just invest money completely separately that we actually get to control and keep. Now, I do think you need life insurance if people depend on you and your income. So if you are married, if you have a parent that depends on you, if you have children who depend on your income, then you do need life insurance. Typically, you're going to need somewhere between 10 and 12 times your annual income. So just to keep it simple, if you're making $100,000 a year, if that's your take home, right? Maybe your taxable income, then you probably need around $1 million in life insurance. Because if you were to die, those people who depend on you have that $1 million. They're going to be able to live for quite a good amount of time on that money, right? So theoretically, they would invest it, and then they would take some of that money out every single year. And I'm a proponent that even when there is a spouse that doesn't work outside of the home, maybe they are a stay-at-home spouse, they also need life insurance as well. Because if they were to die, someone needs to do the work that they were doing, right? It doesn't just magically go away. If they are home caring for kids, you probably need to hire someone, maybe a nanny or pay for daycare, right? There's additional services that you would need as a single parent to continue to keep the family going. And so you want life insurance to help you be able to do that. That amount might be smaller, but you do typically want to have life insurance to cover that parent. I've heard some financial planners recommend that if you have a spouse that is not working outside the home, that you should at least have enough life insurance to pay off your mortgage. And I actually really like that advice because let's say your spouse dies, completely tragic, but you have enough money that you can pay off your home mortgage. Then you never have to worry about housing again. That probably frees up a whole lot of income for you, right? That you were paying towards the mortgage. Now you've got a lot more available cash flow within the household. So you can possibly take some time off. You can hire some help. You can work less. Like it gives you a lot of flexibility. Now, over the years, as your income goes up, you might need to ladder your insurance policies. So if you get for your first life insurance policy at 30 when you have your first child, maybe you are now 40 and you're making a whole lot more money. So you can decide to add a policy. You keep the one that you got when you were 30, you can keep that. You can add a brand new policy on top of that. So term life insurance means that there's a beginning and an end to the coverage. So if you get a policy when you're 30, in many cases, you're going to get 20 or 30-year term life. So that policy when you're 30 will cover you until you're 60 years old. And at 60 years old, hopefully you are at that point self-insured. So your kids are out of the house at that point, they're out of college, they don't need you anymore. And maybe you've paid off your home or you're close to paying off your home. So the financial needs of the household are just much, much smaller. So at that point, you let the policy expire. But when you're laddering insurance policies, then maybe at 40 years old, you're getting another 30-year term life insurance or maybe a 20-year. So that for those 20 years, you have two different policies in place. And they are going to cover you still until you're 60 or maybe until a later point. So that is always an option where you can add coverage on top of that. There are some cases where if you're still really healthy, you can just replace the policy with something that is bigger and maybe cheaper. Sometimes insurance goes down in cost, but you're still protected if you had a health scare, if you had a cancer scare or something happened, maybe you developed a chronic health condition and your premiums are really high at that point. Laddering allows you to keep the old insurance policy that was cheaper and just add additional insurance. Or in the case, hopefully that never happens to you, but that you are no longer insurable, the policy that you already had in place stays in place. And so getting life insurance in place when you are young and healthy is always great. But the next best time is today, right before something happens. So I think that is an incredible gift to give to your loved ones to have life insurance in place. I would very much prefer not to die, right? My children are still of school age. My goal is to be there, long into their future to see them have children if that's what they want to do, right? That is absolutely my hope. But if I were to unexpectedly pass away, the last thing I want is for them to have to be super worried about money. How are we going to stay in this house that we all love and that they grew up with, right? I wouldn't want them to have to worry about that. So I see it as an incredible gift to my dependents to have life insurance policy in place. But I only have term life insurance because that is all I need. It is by far the cheapest way to get insurance. I've said this before in other episodes. I do think simple is good when it comes to finances. When you understand the mechanics, right? I know that my life insurance is just life insurance. That is not anything else. It has no other purposes. And when I make that premium payment every year, what I am buying is peace of mind. I will not get anything back at the end of that. But by paying that life insurance premium, I am transferring risk. I'm saying it is unlikely that I will die, but should I die, I am reducing the risk to my loved ones. So that is ultimately what you are doing, right? To some people, it feels like, oh, I'm throwing money away because I'm not going to get any of that back. That's not that. I choose to see it as a risk transfer, not throwing money away. I am protecting my loved ones and I really prefer to not die. But should I die, I've transferred the risk. They are absolutely going to be okay because there's plenty of life insurance money available for them over there. Now, going back to universal life, whole life insurance, there are some very specific situations where that can make sense, but those are going to be the exception and not the rule. Those are situations with high net worth individuals, people who have assets that are in the 12 million and above net worth. So $12 million is a lot of money. You would have to have assets that are more than that before I think you should even think about whole life or universal life insurance. Until there, I do not think you should consider it at all. And I mentioned 12 million in assets. That's in part because for 2024, the If you have an estate under 13 million per individual, it's actually 13.61 million, it is not taxable, right? So if you die, 13.61, that's the 2024 number, it changes every year, it is non-taxable. So if you have an estate that's worth more than that, then there are some insurance products that could make sense. But if your estate is below that, which for most people, honestly, that's where we're going to be, right? With an estate worth less than 13 million, you do not need these garbage products. Do not buy them. For most of us out here in the real world, simple, low-cost products are what is going to serve you really well. It's going to allow you to support your family and those that depend on you should anything happen to you. And that's all you're going to need. So talk to an insurance broker, preferably someone who can shop around with multiple companies, not someone who can only work with a single company or only sell you products from one single company. That's not a broker, that's an insurance agent. You want to talk to a broker who can get you the best deal on life insurance for you and buy term life insurance. If they try to give you something else, go to someone else. Don't do it. It's not a good idea. See you next time.
The information contained in this podcast represents the host and guest's general opinions and should not be construed as personalized accounting and tax advice. Listeners should consider all facts and circumstances before applying this information and seek appropriate advice from an accountant, financial planner, lawyer, or other professional. Any info provided does not constitute accounting, tax, or legal advice.